Hello, everyone. Thank you for joining today's web conference, the City National Rockdale 2025 Outlook. My name is Jules Schwingler, and I am a senior investment consultant at City National Rockdale and will be moderating today's presentation. I'm joined by key leaders from City National Rockdale's investment strategy team, including Chief Investment Officer Charles Luke and Senior Economist, Senior Portfolio Manager Paul Single. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During our call, our presenters will discuss the key themes and trends that will define the economy and financial markets in the year ahead, and explore actionable insights for portfolio positioning in this dynamic environment. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar. So please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the resources window on the right side of your console. I'm now going to turn the call over to Charles Luke of City National Rockdale.
Thanks, Jules, and thanks everybody for joining. It's my pleasure to be bringing in the end of 2024 and the beginning of 2025 with you. So nothing short of a lot to discuss today. Certainly been a fantastic 2024, and we just want to share our thoughts going forward as we move into next year. So we're going to set it up in a global theme summary just to get started, just let you know what's on our minds, some of the core impacts that we think are going to come into play early next year. Paul's going to jump in and talk about the economic and macro environment. He's also going to spend a lot of time just on policy implementation by the Trump administration and what we expect there. And then I'm going to come back in and I'll talk a little bit about the markets and some of our outlook there. So to get us started on the speedometers, despite being a major source of uncertainty over 2024 and for most of the year, the election's now past us. So I do think there's a collective feeling in the market going forward that we can kind of deal with this and take the next steps. So it's very nice to have that behind us. And I do think that's reflected in the broader economy and highlighted by the strength in the advance of U.S. markets. And it certainly doesn't hurt here that the markets have turned in a fantastic 2024 across the board, especially when it comes to the equity market. So if we think about equities, we think they're in great technical shape. November saw one of the largest inflows on record, about $120 billion into U.S. markets. And that really fueled the rally that we saw post-election. And I think in the economy, we're looking at a variety of positives. So that's Federal Reserve easing, strong consumer spending, stable interest rates, climbing sentiment among consumers, and definitely solid corporate earnings, which we'll talk a lot about. And we did make some changes to our speedometers immediately after the election in November. And so when we talked about this on our investment committee for the month of December, we decided to keep things the same because a lot of those changes are still consistent with what we see. So to focus on some of those recent changes and to talk through what we think could change going forward, it really starts with the business outlook. So one of the things that I'm very optimistic about is kind of pre-election, and we talked about this on October 31st, the last time we were with you. We felt like businesses were in a situation where they really didn't know where to make investments and weren't confident in making those decisions until they knew who was going to be in the White House. And so I was just sitting with a small cap manager at dinner this week here in Manhattan. He was talking about being on a road show with a bunch of corporate CEOs. Everybody was optimistic moving forward into 2025. So I do think there's going to be an unleash of spending, could be a little bit of buildup in inventory ahead of the tariff situation we could see. But overall, the business outlook is in the green and it's very positive in terms of how we see it. The other area is monetary policy. So you'll see our speedometer is fully in the green there. Certainly expectations for Fed cuts in terms of where they're going to be at the end of 2025, which previously was about 3 to 3.25. That's changed. So the Fed isn't going to be on as steep of a cutting cycle. And so we see them somewhere between 3.75 and 4. And we'll talk about that when we get into our forecast. The other area based on the Trump administration is fiscal policy. So in November after the election, we took fiscal policy from the yellow zone, kind of straight up arrow at 12 o'clock, into the green zone. So we do think a lot of the initiatives, DOGE and what that could potentially do for efficiency, deregulation, are all going to be tailwinds in addition to tax cuts that we could see on the fiscal side. And then the other area is just sentiment. So I think one of the most telling statistics that I've seen here lately, despite getting inflation this week, is on Tuesday, we had small business optimism released, and it was one of the highest levels we've seen since 2018. So that's very positive. And then the last thing that I'll note on our speedometers is that we do remain very positive on the labor market. So there was some concern earlier in the year that the unemployment rate would rise quickly. It did rise to about 4.2% today, but shooting beyond that has not materialized. So we do view the job market today as generally balanced as we move forward. And then shifting into our forecasts, we do remain positive on growth. It definitely surprised in the upside during 2024. And we continue to see a slight moderation, and that's backed up by a very healthy overall economy. And so this is an environment where we think growth is really normalizing to trend. And right now, expectations for corporate profits are very high. They're running around 15% at consensus for next year. We do expect things to moderate there a little bit, and you tend to see downward revisions. That's common. It happened in Q3, but then we surprised about 3 percentage points over that. So we're going to see those come down a little bit. And we'll go through a very simple example of where we see S&P 500 fair value based on that consensus earnings level and tax cuts. But generally, we think earnings look to be in very good shape and broadening out as we move through into 2025. And then this week, we did get inflation reports. So moving to our forecast there, generally, the month-over-month numbers were consistent with where they've been. So they came in at about 0.3%, and that goes back to about March of 2022. That's where the average has been. The headline number on nominal CPI came in at about 2.7. But what's really been the focus here has been the core numbers with services, spending, and housing. So they call that shelter in the numbers. That continues to drive a lot of the inflation that's keeping it at this sticky level above 3% on core. That excludes food and energy. And that's really bottomed back in July. And some of the concern is that the pace has picked up a little bit. And certainly with some of the policy implementations on inflation and interest rates, there is some concern around that area, and we'll talk through that. But as growth does continue to normalize over 2025, we do expect inflation to be between about 2.5 and 2.75 over the year. So not falling back to the Fed's 2% inflation target, but certainly not the 7, 8, 9% type of numbers that we saw over 2022. And then on the rate side, this is where we've seen some high volatility after the election. And the Fed meeting is going to be next week. So right now we're at 4.5 to 4.75, and we do expect to see a cut on December 18th. But what's important here for us is that we didn't follow the market down when the Fed came out with guidance in September that they wanted to be between that 3 and 3.25 level at the end of next year. So if we actually look at where those implied rates are today, it's about a 3.8% level 1 year from now. So we really don't think the Fed can cut as much as they want to cut. It is a healthy job market. They're going to be concerned. They're going to want to make sure they put grease in the engine for that. And they do see stubborn services inflation, but they've got to thread that needle. So I do think they're going to have to keep inflation, they're going to have to keep inflation under control and rates relatively high. And so if you shift to the 10-year forecast, it's right now just outside of the top end of our range at about 4.3%. Just last week, we saw it at about 4.1 to 4.15. So it's really been chopping around this range. But this is another area where we've been out of consensus. We think rates are going to stay stable. They could trade back as high as a 4.5%. I think there's even an outside chance that we could see that 5% level. But it is good for bond portfolios because if we have rates that are staying high, it definitely gets that income component up. And we don't think they're going to be able to stay high for very long at those types of levels. So this 4 to 4.5% area is something that we're quite excited about, and we think rates are going to stay in this level, and that's going to be good for investor portfolios. And so moving on into our global themes, we've broadly funneled these into about 4 different categories. And so the first, undoubtedly, is going to be Trump policy. And there are a lot of components to this. You've heard us talk about tariffs, immigration, taxes, deregulation over time, and we've analyzed that very specifically. But what we're adding to this list is digital currencies and certainly debt and deficits and what the impact could be there. The second area that we think will have a particular impact in 2025 is on the geopolitical side. So I'm sure that we've all heard at this point the situation in Syria. We also still have U.S.-China relations, what could potentially happen there. There's been some tit for tat lately with what has happened to NVIDIA and the investigation that will be undertaken by the Chinese government there. And there's also tariffs and potential situations for disagreement. U.S.-Russia remains a major issue, especially with funding of the Ukraine war. Tariffs are going to impact Europe, There could be energy security and supply chain issues, especially from what's happening in the Middle East. And so we're really in a situation here on the geopolitical front where things continue to be relatively hot. So that's going to be a major topic in 2025. We also have AI acceleration. So I've been talking a lot about this over the past couple of webinars, but we're a firm believer that AI is going to be a multi-year, potentially a decade-long type of run. Right now, we've gone through the first wave just of exposure to the technology, and we're looking at the second and third waves. So investment in power and infrastructure, investment at the enterprise level for corporations, for their employees to use that, efficiency gains in areas like healthcare, inventory management. And so that's really something that we think is going to underscore what happens in 2025. And it's going to be much broader than what we've seen just isolated to tech. We think it's going to have a major impact across other areas of the market. And then the last area that's very important is where are we with equity valuation? And at a 22 times PE on the broad market, what does that mean for forward returns? And what can we expect for ranges going forward? So if we move in first to the economic impacts of policy, there's a lot to say here. We've got green on the screen, we've got red on the screen, we've got some yellow on the screen. But ultimately, when we take a step back and look at the policy impacts across the board, it is a bit of a puzzle. And I think it's important to note that these policies are not going to be implemented in a vacuum. So if you take tariffs alone, certainly there's some scary elements of that related to inflation and interest rates. But if you take immigration and demand coming out of the economy, that could potentially balance it out. So I do think there's the opportunity here as policy gets implemented for cancellation of each other to take place. And certainly for a smaller impact overall to sort of impact overall markets, inflation, interest rates. I think it's going to be a mix and policies might cancel each other out. And we're certainly not cherry picking here. So we do think that there's a potential negative impact. It should raise concerns around those areas of inflation and interest rates. But we think the pro-business mindset is going to be the #1 item moving forward that's going to be good for the market. If you think good things will happen, if you think you'll be supportive, then you're free to make better decisions. And I think based on a rate view, it's also a great opportunity for clients to continue to take advantage of interest rates if they stay high and certainly position long-term portfolios. And if we look at most policies, especially lower tax rates, deregulation, fiscal support, maybe efficiency gains from Elon Musk's Doge endeavor, they're all beneficial. And we do think this will broaden out corporate earnings, and it's going to give domestic companies especially a pretty big boost. And this is a reason why you'll see in a little bit why we like small and mid-cap positions as much as we do right now. The other big component here is Trump administration support for digital currencies. And if you take that in combination with antitrust regulation, which has been a pretty big theme happening and a threat to tech, that's likely to not be as big of an issue. So I think most of the tech companies in terms of that regulation, that'll calm down a little bit, and it's going to provide a continued runway for tech. So I don't think the Trump administration is negative for tech at this point. And then when we think about the addition of small and mid-cap exposures, we do believe it's a good time to overweight equities, and that's balanced against longer-term risk-taking with the fixed income portfolios. And so in these scenarios as well, in addition to equities, in addition to fixed income balancing things out, we think some alternative markets are very attractive, especially on the credit side. So structured credit with heavy exposure to more cyclical companies, domestic-based companies, areas like direct lending, and even private equity, which could restart with M&A activity. We're pretty excited about what could come in 2025. So if we take all of this in totality, policy implementation's going to be a mix. We'll see how it mixes together to produce outcomes. But what I've been telling clients about this environment, and really what I've been telling clients since about the beginning of 2023, the opportunity set to deploy assets right now is very rich relative to what we saw in the decade prior to 2020. So we're excited about getting these portfolios going and taking advantage of the opportunities in a tactical way as we move into 2025. And so the next theme, just to move into the geopolitical landscape here, one of the big headlines that we saw here recently was Xi was actually invited to Trump's inauguration. So we've already had unilateral conversations with Canada, with Mexico. Certainly, this highlights the China relations. And so we're going to see headlines here a lot. And let's talk first about conflicts. So if we look at what's happening across the world, we've highlighted the fact that for us, the biggest long-term impact is likely to come from China and the potential output to Taiwan or outcome on Taiwan. And I think that's the longest-term strategic issue that the U.S. is going to face. So I'd classify that as sort of the number one longer term geopolitical risk. We also have Russia and Ukraine, and what's been happening there certainly hasn't been quite as of a focus, especially with what's been happening in the Middle East, but it still costs the US a lot of money. So when we start talking about debt and the requirements to continue to support that war effort, I think we'll have to see what happens under the Trump administration, but definitely remains a huge risk factor. And then moving into the Middle East, we have the situation with Syria, and I think resolution to these Israel conflicts is going to remain very elusive. And I think what Syria underscores is that there are conflicts that are happening in situations that are out there that may not even be on anybody's radar. So we do view the Middle East as sort of a major flashpoint and something that could have unforeseen consequences in the markets. Right now, there's not much of a reaction, but certainly if the US is drawn in further, that could be a negative situation, and we're watching it closely. The other items that I have on this page, just outside of the conflicts, is what's happening with US trade. So in our opinion, Trump here is really going for the jugular and trying to make good on a lot of his campaign promises. So if you look at that top right chart, this shows US imports and US exports. You can see the largest trading partners here are Canada, Mexico, China, and the EU. And we've already had shots across the bow in terms of how Trump might apply tariffs. And that's something that he can do in a more unilateral way when he does take office on January 20th. So that's going to be a big thing if he follows through with those. The wild card is this positioning from a negotiation basis, or is this something he's really going to follow through with? And we don't have an answer to that yet. The last impact on a geopolitical front is going to come from the dollar. So the dollar is up about 6.5% since late September. And one of the, I think, most significant things that's happened is what's happened with the BRICS and how Trump has positioned the US economy against the BRICS. And so what are the BRICS? First, it's an economic and political alliance of emerging nations. And so it's Brazil, it's Russia, it's India, and it's China. They make up the core. And the goal of the BRIC Union is really to foster mutual development among these countries and increase economic influence. But what happened was with the sanctions that followed the Russia and Ukraine war, discussion around alternatives to the dollar amongst this group have really gained steam. And that creates concern around the debt, creates concern around US exceptionalism around the world and influence. And so what Trump came out and said was that if the BRICS were to pursue a new currency or any dollar alternative, that it would result in about 100% tariffs on trade with the US. So that was a very hard line. And I do think that somewhat protects our position, especially with the dollar, and at least gives us a little bit of a longer runway. So all of these issues will be interacting with each other, from conflicts to how trade is impacting things. And certainly that's going to have a downstream impact on currencies. And the next theme that we're seeing is on the AI front. So there's a lot to talk about here. Certainly the financial impact is nothing short of amazing in the market out there, both from an investment standpoint and from efficiency gains and overall corporate revenues. And I want to underscore here, we're not talking about unprofitable enterprises that are running up with high valuations. What we're talking about is an infrastructure here that's so much more efficient to basically deliver these new technologies, and the revenues are following. So we can get to the consumer faster, it can get implemented more quickly, and that's why we've seen such a huge ramp. So some of those examples, if we think about Q3, NVIDIA has tripled its revenue over the previous year, and it expects about $37.5 billion in Q4. That's $150 billion in annual revenue. And earnings themselves are up about 109% versus the same quarter last year. If you look at Meta, their net income has risen to $15.7 billion a quarter, and that's climbed 35% over the same quarter last year. And it's not just happening in these tech companies. So if you look at a name like Duke Energy and Utilities, they've signed agreements with Amazon, Google, Microsoft, and Nucor, and their profits have completely reversed from a loss position last year. Another utility like NiSource, which we do own, that's a prominent utility company in the Midwest. Over the summer, it doubled its peak demand forecast to accommodate about 2 to 3 new data centers in Northwest Indiana. And they have plans with Microsoft to build $1 billion data center in Northern Indiana. And then one of the most interesting stats that I've seen lately is the Blackstone data center. So they're building a 615-acre site, 16 buildings, 6.6 million square feet of data storage, $1 billion investment. And that's not to mention that Georgia's energy demand, and basically their second place position in data center development, has increased their power demand in the state by 39%. So what I see here is the same mistake getting made over and over again in terms of the market view. Just because the technology is new doesn't mean it's not good or it's going to fail. I think you have to go back to trust, verify. So you can't let pessimism overtake this growth story and the impact that we think it's going to have in 2025. And moving into equity market valuations, what I'm trying to show here is that there's no doubt that valuations have driven a lot of the returns over 2024, but earnings have been a big component of that too. But what's also been tremendous is the amount of flows coming into the market. So if you look at the cumulative net flows that hit on the ETF side this year into US equity markets, about $617 billion came into the market this year, which is tremendous. And I think what this reflects is just the US attractiveness and the comparisons globally. So when we think about these flows and how they're coming in, I think the bottom line is the US should trade at a premium. And so we can't fall into this valuation trap. So the way that I describe this is it's the difference between something like building a home and using builder grade materials or using luxury materials. You'll get some good use out of the builder grade materials, but eventually you're going to want to upgrade to the Kohler and the Moen fixtures, get the double pane, get the insulated windows. And just because builder grade is a good value, it doesn't mean it's a better initial decision. And I think the same thing applies to Europe and other international economies. Just because it looks like a value doesn't mean it's going to have better returns. And so if we kind of put some meat on the bone with that, if you look at Europe right now, it's plagued by a lot of political volatility. So you've got France and Germany, they're struggling with government control. Think about the Eurozone, they reported 0% growth in 2023. They've just expanded modestly in 2024, despite very supportive monetary policy. If you look at earnings for non-US developed, they're paltry compared to the US, so between 2 and 3% compared to our estimates for 15. Europe's also going to be in the crosshairs of tariffs. I mean, they have long-term demographic challenges. So there's some real issues happening in Europe. It's not much better in Asia. If you look at Asia Pacific, excluding Japan, it's up just 14% this year. Japan itself, after jumping out to a huge lead, is now just up 11% year to date. And the Chinese stimulus measures, although they've created a near-term bounce in the markets and they've created significant volatility, they're still down about 4.1% this quarter, and they've advanced 20% this year. That's 10% behind the US market. So ultimately, we think that US equity market valuations can be sustained by the demand coming in from a lot of the international market. And to move into sort of one of the last things that I want to talk about overall with our themes is what's happening with gold and digital currencies. So what do we do about Bitcoin? And I think one of the biggest things here in 2024, January 11th, spot Bitcoin ETFs were essentially sanctioned by the SEC. So we got into a situation where we had a huge amount hit the market, a very liquid tool to invest in Bitcoin, and we've had a rapid AUM growth. So it's up almost over $70 billion just in that flow, just in that AUM growth over 2024, and it's more liquid and easier to access. You also have the Trump administration. They've got a pro-crypto stance here. They did establish the AI and crypto czar at the White House, so the regulation path could become a lot more clear. And there's been more institutional adoption, and certainly prices have made all-time highs, hitting around 104,000 just about a week ago. So there's a lot going on in the digital currency space. We're evaluating the impact to portfolios, both on a risk and return basis. And we do expect to have a pathway for our investors to open up to digital currencies in 2025. And then if we think about sort of legacy assets that might protect against different adverse moves like gold, we think gold is really being driven by central bank buying, and that's on the right-hand side. So it's really being propped up technically by that. But if you look at the traditional forces that drive gold, the pace of inflation isn't rampant. It's certainly decoupled from other real assets like energy and broader commodities, and the dollar isn't weakening. So we think its price is at risk. We did come out on October 31st and said, based on a potential election outcome, we could see gold falling. It did fall about 9% post-election, and it's recovered here slightly, but we just don't see the bullish case for gold going forward. So to kind of summarize our takeaways for global 2025 themes, and then I'll pass it off to Paul. Economic growth in 2025 for us, will be driven by pro-business Trump administration policies. We are going to see some Fed easing here, not as much as may have been previously expected, but it's still going to be present. And then we're backed up by a solid consumer and solid corporate profit growth. We think that a lot of the pro-business policies are going to boost growth, but we need to keep an eye on debt and inflation. But ultimately, that policy mix, I don't think those are going to get out of control based upon what we could see. The geopolitical dynamics in the market, if you think about instability in Syria and the Middle East, it's going to evolve. But we do think U.S.-China relations will play a central role in 2025. We talked about AI and just the sheer volume and mass that's happening there and the revenue benefits. We do think that's going to continue to fuel spending growth. And then strong earnings and capital inflows internationally should support a lot of the high equity market valuations that we see and could sustain the rally. And then we're also seeing digital currencies gain momentum, and we're doing a lot of work around that and how it could potentially impact our client portfolios. So I'll stop there on our themes, and I'm going to hand it to Paul on the economy.
Great. Thanks, Charles, and welcome to all of you. We're glad that you're here. I'm going to just start off talking with taxes. It was a primary campaign issue in the 2016 campaign and also the 2024 campaign of President-elect Donald Trump. The chart on the left just shows the history of the income tax rate that we've had. Income taxes started in 1913. That's when it became legal with the ratification of the 16th Amendment. You can see the maximum amount in the dark blue, the minimum amount in the light blue. The maximum amount has shifted around quite a bit from a low of 6% to a high of 94%. But since World War II, it's pretty much moved down, and this mainly has to do with simplification. When the tax rate was much higher, there were an awful lot of deductions that were available to individuals, and there's an awful lot of cheating. So by getting rid of an awful lot of that and reducing the rate, it's made it far more consistent. Overall, this time, the amount of money coming into the Treasury has been pretty consistent with the size of the growth of the economy, but the simplification, of course, has helped out. The right-hand side just shows the differential between what we're currently paying for our tax rates versus if the tax rate changes and they don't make ratification to the changes in the tax law, what it would be. It would go back to what we had beforehand. But that's the important issue that we have going forward. And this is where the focus for us in terms of investors is what exactly will play out. The president-elect does have a pretty aggressive agenda in terms of adjusting taxes. He does want the Tax Cut and Job Act, the TCJA, to continue going forward for at least another 10 years. He would, of course, like to make it permanent, but that's a little bit more difficult for Congress to make happen. He also has talked about bringing back the state and local income tax deduction, the SALT. Also reducing corporate taxes, especially for domestic manufacturers. And of course, the exemption of some sorts of income like that from Social Security or from tips. He also is looking at other ways in terms of increasing revenue, in terms of repealing an awful lot of the green energy tax credits, and also the tariffs, which is a big deal in terms of risks to the economy going forward. And we'll get into that in a moment. Some of the policies that he have are very well thought out and will help grow the economy. Some will help slow down the pace of economic growth, and that, of course, being the tariff issue. On this next page, and we're going to go into a little bit detail about tariffs. This is the long-term history of tariffs, and this chart here just shows this percentage of products coming into the United States and how much of that has been taxed. Over time, that's changed quite a bit. Up until the income tax, one of the primary sources of income for the federal government was tariffs. It was an easy way to tax. It was very difficult to tax income back then. But as time has moved on, it's become less and less of a source of income for the federal government. And there have been changes to that. First of all, the Smoot-Hawley Act, which is probably best known, it used to be blamed for the Depression. Now it's only viewed as a way of contributing severely to the, not recession, to the Great Depression. It put an awful lot of risk because the United States all of a sudden started to tax 20,000 items. There was reciprocal taxation going on by other countries, and it really hurt the global economy. In the early 1930s, Congress, who has the power to determine tariffs, gave some of that power to FDR to try and negotiate trade deals, because the hopes was by reducing an awful lot of tariffs, we could get some trade deals. We could increase our exports. They could increase their exports of certain products. and all of a sudden the global economy would be much better off. And that seemed to play out a little bit. But it wasn't really until the end of World War II where GATT was established. And that changed things dramatically for pretty much all the major countries of the world in terms of reducing trade barriers, reducing tariffs, increasing global trade, because the common belief was that by trading with one another, you're less apt to go to war. So you can see since then, tariffs have pretty much fallen off in terms of the amount that we tax for products coming into the country. And it's also fallen off in terms of revenue. This chart here, the dark blue line, just shows the dollar value of tax revenue coming from tariffs. You can see how it has increased most recently when Donald Trump imposed tariffs on China in his previous administration. But as a percent of the money coming into the federal coffers, it's not that much. It had been much higher at 20% back in the 1930s, but it's just a very, very small percentage right now. But the talk that's going on is that we may see that increase. And that will be helpful because that will help offset tax cuts in other parts of the economy that the president-elect is considering. In terms of the goods that we bring into the country, that's an important issue. Here you can see that global trade's been very, very important to the U.S. economy. This is the total amount of goods that come into the United States, and it's tripled since 2000. And it's become a significant part of our daily life and what we learned to expect. The light gray area is probably the most important for some people. That would be consumer goods. It's a large share of what is brought in to this country. And these are the things that, all teenagers would love to have. And it's a pretty sizable amount. It's about 25% of our imports. The light green that you see there, that's also a very important part of the economy because this is capital goods. These are physical assets that come into the country that are used to make other products here in the United States. So it's like a semiconductor or steel coming in to help make a car. Putting a tax on these will help increase the price of an awful lot of domestically made products. But even down at the bottom, the very dark blue, that's food. It's just a small percentage. It's less than 5%, but it too would have a big impact in terms of how Americans live. Food, in terms of fresh vegetables, that makes up about 40% of what we eat. It's about 60% of the fresh fruit that we eat. And it's about the same amount, 65 to 70% of all the fresh fish that we eat. So you can see putting a tax on all of this would have a big impact on everyday life. Now, in terms of DOGE, this is the Department of Government Efficiency. This is something that's pretty powerful in terms of financial assets, and it really is being driven by the belief that if the country can reduce a significant amount of regulations that's going on in this country that we have, that would help out stock prices quite a bit because it would improve profitability. And that's probably been one of the major driving forces of the U.S. economy for the last 4 or 5 months or so. But it's interesting to take a look at what's actually happening in terms of the government efficiency. The chart on the left just shows how the federal government spends money. The dark blue is its consumption. These are the things it buys, anything from tanks and battleships to office printers, or who knows, maybe some offices still have fax machines. That's the consumption part. That's been falling off pretty significantly. That's not been a big part. It's the light blue. This is the key part in terms of if the government is going to reduce the cost, the $2 trillion that they talk about reducing from government expenditures, this is what they have to tackle. And this, by and large, is things like Social Security, Medicare, and Medicaid. That's going to be a very, very difficult thing to do. That will require congressional approval. In terms of all the talk of government employees losing their jobs and so forth, we'll see how that also plays out. The chart on the right, the dark blue line, just shows the number of workers, but the shaded area just shows the number of federal workers as a percent of all those that are working. And you can see that that's been shrinking for some time. The government has become more and more efficient in terms of reducing the headcount compared to recent history. One of the biggest issues, that's not just an economic issue, but it's also a social issue, just surrounds immigration. And it's hard to know how many people are in the United States that are unauthorized. The chart on the right just shows some of the estimates, either from the Pew Research Center or Homeland Security. And it's around 11 million, of which about 8 million are working, which represents about 5% of the workforce. The difficulty that we have here really surrounds the fact that who will do that work if they're forced outside the country. If the unemployment rate were at 10%, there's probably enough capacity to fill an awful lot of those jobs. But with the unemployment rate as low as it is, it becomes a little bit more difficult. And we'll see how this one plays out. Again, it was a strong campaign issue, but what we know from the first administration is that Trump follows the stock market very, very closely. And as a result, if there's uncertainty in terms of the amount of people working in a dynamic economy like we have, that could, of course, impact earnings and affect the stock market. That one we'll just have to see how it plays out. But it's the deregulation, as I talked about before. This is probably the biggest issue in terms of strengthening the fundamentals for an awful lot of stock prices. And the chart on the right is a relatively obtuse way of measuring how much regulation the federal government has. It measures the amount of pages in the Federal Register, which keeps track of all the laws and requirements in the country. And you can see that in the last time that Donald Trump was president, they severely cut back the number of regulations. And the expectation is this time it will be far more extreme, again, helping out the stock market quite a bit. Just for an overall view in terms of how the economy is doing, it continues to do well. GDP growth in the fourth quarter is expected to exceed 3%, capping off a very, very strong year of the economy. But things are changing. The expansion is aging. The chart on the left just shows the payrolls. It's volatile on a monthly basis. You can see that in the columns. So the dark blue line is just taking a look at the 6-month moving average. And you can see right now it stands at 143,000. A month, 6 months ago, it was about 100,000 stronger. So it's getting down to that level that's consistent with the amount of people coming into the workforce, which is not a growing economy. So this is the main reason why the Fed's been cutting interest rates and was very aggressive at the start with 50 basis points, 25 basis points, and another high probability of another 25 basis points next week, because they know interest rates are extremely high and they need to bring them down to help encourage people to start borrowing money to buy an awful lot of things. Secondly, the chart on the right just takes a look in terms of the growth of different sectors of labor. And you can see that most of the growth is happening in areas that are not the cyclical areas, the ones that continue to hire people month in and month out, such as education and health services, government workers. You also see it with leisure and hospitality. The surprise here, of course, is construction. That is highly cyclical. But as Charles was talking earlier, in terms of data centers, you also have the Infrastructure Act. You also have the CHIPS Act. Demand for construction workers is extremely high. So that's why it's performing so well in terms of the growth. In terms of the inflation story, as they say, the last mile is always the hardest. This chart here is just showing CPI and core PCE, which is the Fed's favorite measurement of inflation. It's getting down towards 2%, but it's not there yet. CPI actually, with yesterday's release, has increased on a year-over-year basis for the last 2 months. But the underlying fundamentals are very good for it to continue to decline, and that's why the Fed is very willing to cut interest rates next year. And that's based on the sticky things like housing costs. We've seen some good news of late in terms of those prices coming down and continuing that trend. And you also have the strength of the dollar, and wage pressures aren't nearly as strong as what they had been in the past, especially with the employment cost index, which is the Fed's favorite measurement of cost of labor. But this final chart here, in terms of just showing what the Fed is doing and what they're thinking and what the market is thinking about all of this. Well, once a quarter, they make projections in terms of things like the federal funds rate, inflation, unemployment rate, and GDP growth. And this is based on the most recent one, which was in September. And based on that, they still have, you can see it in the columns, 25 basis points cut this year. Next year, they plan 100 basis points, plus the 25 that will happen hopefully next week. And then the following year, another 50 basis points. But if you look at the line, the Fed funds futures market isn't as aggressive. And there's a couple of reasons for this. One is the fact that there's a great deal of uncertainty next year, and maybe the Fed will step back a little bit to try and find out what all these policy changes will happen and what ones will impact the economy. The mix will be an interesting thing, as Charles mentioned earlier. And the other issue is the natural rate. It might be a whole lot higher than what people assume. Now, the natural rate is hard to explain to an awful lot of clients, but it's that rate of the Fed funds rate would be at if the economy is expanding at a good pace and inflation is not a problem. And it moves around an awful lot. It's not observable. It's based heavily off of a model, or there are several models for it, or just outright guessing. And the fact that we will have such a large deficit, the fact that there is such stimulus, maybe the underlying interest rate is a little bit higher than what they had assumed. So that's the reason why the financial markets don't expect as much of a rate cut as the Fed thought back in September. And we'll see how that plays out. But the outlook for the economy is that it will continue to perform well. It's doing extremely well right now. You have the ability to have maybe more fiscal stimulus coming in, and that will help things out. But it's the consumer that's been driving the growth the most. But it's the Fed. That's going to be the interesting play for next year. And there's so much uncertainty compared to what we've had in the past, again, because we don't know how much of the aggressive agenda by the administration will be implemented and how much doesn't and what offsets what. So stay tuned. Now, let me turn it back to Charles. Charles.
Great, thanks, Paul. So let's get into the equity market, talk valuations, and then touch base on bonds as well. So first and foremost, I just wanted to level set, give everybody an overview of our earnings sort of from the top-down perspective on what that forecast looks like, talk a little bit about the disparity in valuation. So first and foremost, in the top left here, we think earnings are going to continue to be very good in 2025. We're not quite as optimistic as consensus, which is kind of mid-teens, but we think that 12.3% level is really in the midpoint of that 10 to 14 we showed you on our forecast slide. And then the right-hand side, this is where all the noise is. So if we take a look at equity market valuations, the Mag 7's at 35, the broader market's at kind of 22, it's at 19 excluding the Mag 7. We see the equal weight at about 17 to 18 times, and then the average at 16 over time. So I think you have to reach the conclusion that areas of the market are highly valued, but we need to recognize the opportunities that still remain in the market and the dispersion that we see. So a lot of the names that have been rallying since Trump was elected have been financials, consumer discretionary, energy names, the cyclical parts of the market. I talked about utilities and the power demand, infrastructure, industrials. Those are areas where you see some better valuations. So just because you're seeing lofty tech valuations that could quite be justified, right? You're looking at very attractive areas of the market that offer better valuations going forward and potentially maybe a better glide path to catch up a little bit. And I think we have to ask ourselves again, and I underscore this, what does it mean to be overvalued, right? If we think about all the statistics I shared on an international basis, we should be trading at a premium here in the US. And I think we also have to ask ourselves, what's the staying power of that premium? So I'd say three things, right? The pro-US policy of the new administration, that's going to be a major one. Smart business regulation going forward, and I think less global entanglement. And we'll see what the Trump administration is able to do around that. But I think those three things will continue to help power these valuations. And to help illustrate exactly what that means for where the S&P 500 could potentially trade next year, what I wanted to do was take consensus earnings and then hit it with a couple of scenarios where we might get some revisions downward, but then also look at tax policy. And if the full tax implementation were to take effect, so that would be 15% on domestic revenue and about a 20% level on international revenue, how would that impact earnings? And so if you follow this table with me, if we get no change in tax policy and just go off the consensus, it's 14.7. And if we take 2%, 4%, and 6% off, we can see the corresponding earnings increases year over year. If we take tax cuts into effect, we think it's going to be about a 4.7% boost to overall earnings at the bottom line. So consensus would shift to about 19.4, down 2, 4, and 6. You can see it goes all the way down to about 13. And if we look at the S&P 500 valuation based on current multiples, which we think could probably be sustained based on what we discussed, if you look at no change, you've got a range of about 5,800 to 6,150. If you take tax cuts into effect, you have about 6,400 to around 6,100. So if you kind of take your gaze and look at that bottom chart, you look at the two box plots, you can see in a no change scenario where we would potentially be on fair value, and with tax cuts where we would be. So there's definitely room for the S&P to run based on consensus earnings, the potential for tax cuts going forward. And you could see some extremes in these ranges. So you should think about this as the middle range of the data, but we could be way above the top end. And it's certainly not out of the question that we could have a correction at some point this year that we think would be a pretty good opportunity. But right now, we think the equity markets are going to do well over 2025, but taxes are going to be that most critical real impact to earnings, where if we start anticipating that or see that, it could really help drive and give a tailwind to the overall market. And one of the reasons that we're looking at other areas of the market on a valuation basis, just away from the S&P 500 generally, is where are those good valuations? So we talked about some of those cyclical sectors to be investing in, but one of the areas that we really do like, and we've increased our exposure in certain circumstances to, is small cap exposure. And so there's 3 areas I want to talk about on this slide, and I can give you a few others as well. But the first one is on the left-hand side here, and this is U.S. homegrown revenue, so domestic revenues as a percentage of different indexes. So you can see the Russell 2000, which is kind of a mostly small cap index, only has about 21% of its revenue coming from international sources, right? All the way up to the Mag 7 at 49%. So with the policies that we're going to see pro-U.S., strong U.S. dollar, and the potential impact of really trying to restart that domestic economy, we're going to see much more exposure in small cap stocks. Then if we go up in the top right and talk about valuation a little bit, what we're seeing is the best valuations on a relative basis, so the cheapest valuations of small caps versus large caps going back over a 10-year period. And I'll underscore the stat again. I think I talked about it at the beginning, but small business optimism came out Tuesday, and it jumped to its highest level since 2018, so over 100. You can see that in the dark blue line. And these are lightly correlated. So we would expect this to be a leading indicator that small caps, especially at these valuations, could have some outperformance going forward. And then the last area that's really important with small caps is sector exposures. So what I've compared here is the S&P 600, which is small cap stocks, versus the 500, right? And you can see the differences. So with financials, the area that I mentioned could rally here significantly. We've got a 19.7% exposure, 6% over the S&P 500. Industrials, a 9% advantage. And so just by nature of how small caps actually are the characteristics of their sector exposures, you're going to be in a better position relative to the S&P 500. And there's some other reasons too. M&A activity is set to potentially increase. You can look at lower short-term interest rates from the Fed for borrowing, deregulation, which Paul made clear, and then the cyclicality of small caps as well. So we think this is a good opportunity moving forward, and it's one of the primary reasons why we choose to increase our equity exposure a little bit over neutral using small and mid-cap stocks. And to round out just the messaging on the market, this is something we talked a lot about in Q1, but it's the broadening of returns and how that really is a key to the market rallying from here. And so if we look at 2024 versus 2023, there's no doubt that you saw better returns across more sectors than what we saw in 2023. And before we got into Q2, you'd essentially had 5 earnings periods where the S&P 493 was flat to negative. It really started to turn around in Q2, and forward estimates are also, I think, in a good place in terms of those earnings continue to climb. So the broadening is real, and it is a key going forward. And the last thing I'll say on the equity side is that we can't underestimate the Fed in this equation. And in a cutting cycle, stocks and other risk assets tend to do very well, but they tend to do the best when the Fed's cutting slowly. Why is that? It's usually a better underlying economy. There's more stability. There's less fear out there in the market. And I think that characterizes where we are. So the S&P 500 over about 24 months in a slow cycle, so a cycle that takes more than 6 months, tends to outperform a fast cycle by about 10 to 15%. So that tailwind from the Fed, especially if they maybe make a few cuts next year, I think is going to be a real positive for equity returns going forward. So just to summarize what we think on the equity side, overall market valuations are elevated, but we do think there's specific sector opportunities due to better relative valuations. And again, that comparison internationally, we should be trading at a premium. We think S&P 500 2025 performance, it's going to hinge primarily on tax policy going forward. That's what's really going to impact earnings. And we talked about the potential trading ranges somewhere between 5,800 and 6,400 at sort of the mid-range. We think small caps are gaining broad appeal. They benefit from the domestic focus that they have. Certainly, they have more favorable valuations. We get sector diversification, M&A, deregulation, all those things we discussed. And then sustained market progress will need to see the continued broadening of earnings. And we are seeing that as we move into 2025. And then, of course, the Fed is going to be a big impact on returns as we move into 2025, and we think they will be accommodative. So moving into bonds, a couple points we want to make here. First and foremost, and this actually connects back to corporate earnings, but corporate credit health remains very strong. So on the left-hand side, if we think about high-quality bonds and issuers in the market, the coverage that they have in terms of their interest cost is at about 11.7 times. So that compares very favorably to where we've been over the past 15 years, and it's well above the average going back about 35 years. So it's in a really good place right now. And then if we look at default rates, yes, they have climbed a little bit. They went up to about 4.8%, but they did stop there and start to come down again. A lot of the defaults have been concentrated in sectors, but if you look at core industrial sectors, a lot of the areas we think will benefit going forward, they've had much, much lower default rates, well below historical averages. So it's been a little uneven. But the credit environment is very strong. That's another reason why corporate earnings we think have been doing so well. And then if we think about the market and how it interacts with portfolio returns, bonds are back to being bonds again. And income will really help stabilize a portfolio as we move forward. And we've seen bonds balance out these short-term movements that we've had in the equity markets, and that's been much more effective over 2024. So the income component we think is going to help drive returns in fixed income and really help balance out a portfolio. So we're optimistic about that. And the other component, and it's being discussed a lot now, is what's happening with credit spreads. So think about spreads like your credit score, right? The lower your credit score, the more you pay to borrow money. So when corporate bond spreads are low, the bond's credit score is higher. You have to pay more for the bond as an investor. And so right now, if you look at it, bond credit scores are high, so the rates are lower, and the debt is more expensive to buy for investors. That means on the investment grade side, rates are below 100 basis points or 1%. And then on the high yield side, rates are below about 350 basis points or 3.5%. So the question is, can this persist? Can it remain this tight? And it can. So historically, we've seen it last as long as about 5 to 6 years. And so just because these spreads are tight, these credit scores are high, doesn't mean that the market has to draw down from here and we're going to be hitting a credit cycle. So this can continue at these levels, and we like the absolute yield. The other area I wanted to pick out specifically on the fixed income side is leverage lending, direct loans, a lot of the private borrowing that you've been hearing a lot about, versus high yield corporate bonds. So we do think that area of the market is set to outperform, continue to outperform into 2025. What you're seeing on this slide is the difference between high yield bond yields and leveraged loan or direct lending yields. It's at one of its lowest levels in history, which means that loans are much more attractive just on a yield basis relative to high yield. So we do like positioning in leveraged loans and private debt as we move into 2025. And then my last comment just really deals with the tax advantage situation and where that makes sense to be investing. We like muni bonds for our clients that are in high tax states or facing high tax burdens at this 3 to 4% type of level. So if you look at the left-hand side here, you can see that muni short intermediate type of line. It's at about a 5.2% yield at the highest tax bracket with very high credit quality. And that's what we can see on the right-hand side. Rating trends continue to skew very positive for the muni bond market. So we think it's a really good complement, especially to some of these higher yields that you can get in high yield corporate bonds. And then certainly we do offer high yield muni bonds, which now are adjusting up to about a 9% level when you take taxes into account. So there's some great opportunities on the muni bond side as well. And so to wrap up on fixed income, just some key takeaways here, right? Corporate bond fundamentals are very strong. It's going to support the market. We do not see us going into some sort of credit cycle here. Bonds are back to being bonds again. So you have those negative correlations to the equity market, and higher income does equate to better stability in your portfolio. And while the cost to own corporate debt is high, again, that credit score type of component, there are precedents where valuations have stayed this high for a long period of time. And then when we look at leverage lending and floating rate debt, we think that's going to perform very well as we move into 2025, again, as it has outperformed in 2024. And then the muni bond situation for investors that are trying to avoid taxes is still a great option and very high quality and rock solid as we're building out those fixed income portfolios. So I will stop there, and I'm going to pass it back to Jules for some Q&A.
Thank you, Charles. I was going to remind everyone that if you do have additional questions, and we have a bunch, there is that Q&A section inside your console, so please type away. Charles, I'm going to start with you. Can you talk about your thinking and the firm's thinking about digital currencies in the portfolio? What are the considerations that you have? And I'm guessing there might be just Bitcoin and everybody else, but please describe.
Sure, absolutely. And so I think there are kind of two areas that we have to take a look at, and we described these a little bit. But the first thing we have to do as making sure that we're fiduciaries and we're protecting your money is what's the portfolio impact, right? What's the risk in return? Can it be diversifying? Does it have staying power? At a high level, is it worth the risk? We all know that the returns have been there, but we really need to dig deep into cryptocurrency and especially Bitcoin and the liquid options to really understand what that impact is going to be over time. The second thing that I go to when I'm thinking about risk and where to position our clients so that they can be positioned well if the market were to fall and we were to get into a really bad situation, it's what I call sort of the doomsday hedge. So let's just say for a moment, and it's kind of hard to even think about it, but let's say for a moment we do get into a global conflict, something happens, it hurts our influence broadly, the US dollar goes down. To be able to have access to an asset or currency that's not going to be influenced by that situation, sort of with US dynamics, could be a very good hedge against the worst case scenario. So is the risk and return worth it? Is it diversifying? Do we want to have it as part of a portfolio structurally? And then can it hedge outside risk that we can't hedge with other security positions? And those are really the two core things that we're considering as we think about digital currency.
Excellent. Thank you. Paul, I've got a question for you. You and I always get this question, and it's a good one. With all the plans of the new administration, what will happen to our federal debt?
The general belief is that it's going to increase pretty significantly. And it's already pretty high in terms of the amount of debt that we have, especially relative to GDP. The deficit, which is the annual amount, is around 7% of GDP, which is a big number. To put that in perspective, most economists say it should never exceed 3%. In fact, actually, if you want to be a member of the European Union, you're not supposed to have it exceed that 3% level. And that's where France right now is having their problems. It's above 6% right now. And it caused the coalition government actually to be dissolved because they could not agree on how to deal with it. Now, the United States is not France. We have many advantages over what was the French franc originally, but the euro. And that is the US dollar is the major trading currency of the world, and it's used for an awful lot of flow of funds around the world. So a lot of countries need it. But it is a big number. If the goal at some point is to help bring the debt, the total amount we owe relative to GDP down, things have to happen on the deficit on the annual basis. As I mentioned, the debt is 7% of GDP. 3% of GDP is just interest payments alone. 4% is just excess spending. So it's severe. It's been a problem for a long time, but like most credit problems, it's never a severe problem until it becomes one, and then it's very difficult to resolve. So we'll see how it plays out. But I don't think anything is happening in the next year or two. Neither party has made it an important issue in terms of cutting back on the deficit and thus the debt.
Thank you, Paul. I'm watching the time, everyone, and I know we're right up against the clock. I'm going to ask this last question to you, Charles. What are the gathering clouds? What are the top 3 concerns you would have for 2025?
Perfect. So I would start with one that's kind of really out of left field here, but it's something that does keep me up at night because it's such a big part of consumers' wallet spend. But it's natural disasters and the impact on insurance costs. So we're looking for reasons and trying to poke holes in why the consumer, might not be as willing to spend going forward. And if their budget keeps getting eaten up by these insurance premiums, auto, home, disaster, it's really going to kind of affect the amount of money that they can have to spend. So that's something that I worry a lot about. And then how bad will that natural disaster season be, and what will that do to premiums? The other concern that I have is on the housing market. So we're in this transition where housing mortgage rates are still high, but you don't have a ton of new home buyers. New home buyers come in incrementally, but existing home buyers with low rates are not impacted by those higher mortgage rates. But as time goes by, it's the enemy of that, because you have more home buyers coming in, you have people that want to refinance, and that may strain their ability to do so. And housing is one of the biggest impacts on spending. You buy a house, you get a washing machine, you want to outfit it again with those, Moen and Kohler fixtures that I talked about in terms of what you can put in your house relative to builder grade. So that creates a lot of spending. And so that's something that I'm thinking a lot about. And I'd like to see those mortgage rates come down and that spread to compress a little bit relative to where 10-year treasuries are. And the last is sort of an easy one, but I think you have to put it top of your list, and that's broader U.S. involvement with the Middle East especially, or a major disagreement with China, which could impact the situation with Taiwan and directly sort of hit imports and exports. And I think you're already seeing some of this tit for tat, right, with China hitting back with these stimulus measures that they announced this week, plus announcing that NVIDIA would face a regulatory probe. And that's 5 years after that transaction occurred. So you're starting to see these actions back and forth, and I don't hope those escalate to an unsustainable level. But those are really the three that I see, Jules.
All right. Well, I see we're over time. For those of you who had questions that weren't answered, please reach out to your senior investment consultant, and I know that we can circle back with Charles and with Paul and get you the answers to your questions. Thank you all for joining us. Now, a brief survey will pop up shortly on your console, so please share your feedback and suggestions for future topics. A replay of this session will be available within the next 24 hours, and you will receive an email alerting you on how to access it. Have a great day, everyone. Thank you.
Thanks, everyone.